Today's conference on sustainable investing, the why and how of responsible investing for foundations, is an opportunity to highlight today's global challenges. The importance of sustainability to achieve long-term impact and the role of foundation, the role that foundation can play in putting sustainability at the core of their investing strategy, strengthening responsible citizenship. This event is important for us in Geneva, at least for 3 reasons. First of all, because the city of Geneva is a perfect place for addressing the subject of sustainable finance for foundation. Geneva is for centuries a world capital for banking and for investment. It is also an historical capital for humanism, and hence the perfect place to reconcile both. Second, the Université of Geneva is a perfect place for being a forum where we can have free discussions about different subjects. Being a comprehensive university where multiple disciplines can be called up, such as law, economics, management, psychosociology, sustainable finance, and neurofinance, the University of Geneva is the perfect place to address questions related to philanthropy. Finally, it's also a perfect timing, just before the 21st Conference of Parties, the COP21, where sustainability will be in the limelight. If climate change issue will be in the center of discussion in Paris, it is one major part of sustainable development, and we need to imagine how finance can bring original contribution and strong contribution to the resolution of these climate challenges. I'm very pleased to welcome tonight Professor David Blood, whose experience and example from Generation and Generation Foundation will be valuable to illustrate the link between foundation and sustainability and to debate mission-related investments for foundations in the wider context of sustainability. I am particularly thankful for all partners who made this event possible, and particularly Fondation Lombard-Odier, la Chancellerie de la République et Canton de Genève, and Swiss Foundation. I am also very delighted that so eminent speakers have accepted to be with us tonight to share their thoughts with us. David Blood, which will be presented afterwards by Michel Girardin, Thierry Lombard, Lucas von Orelli, and Michel Girardin himself, who will moderate the debate. I wish you a very interesting conference and very fruitful discussion. Thank you very much for your attention, and now I'm going to give the floor to Michel Girardin, who is going to present the main conference for tonight. Thank you very much.
Thank you, Yves, for this kind introduction. I must start with a word of apology. Normally, it should be, maybe you've seen on your original program, it has been changed very recently. It should have been Professor Philippe Kruger, a colleague of mine at the Geneva Finance Research Institute, that would moderate this panel. But he had to go to the US, actually. He changes from you. David came here and he fled to the US. And it's for a very good reason, and we're actually very proud about this. He received the award, and it's the primary and only global award which is given for excellence in academic research in the field of sustainability and sustainable investment and impact finance. So we're very proud of this. And the prize is going to be announced in a couple of hours. So I asked Philippe where we could, have a preview, and if I could tell you, I know maybe after when we have a go to cocktail, you can tease me, find out which prestigious university in the US is given this award. But for the time being, he said, yeah, no, I don't want to have any tweets of people before the announcement is made public in a couple of hours. But we are actually very proud that he won this award for. It is, in our view, yet another sign of excellence for the university and also the city of Geneva, with many partners which are here dedicated to sustainable finance, and indeed the will also of the political representative here of the city and the canton to really place Geneva at the heart as one of the most important center for sustainable finance. Okay, yes, this is the Geneva pride. David, sorry for this. Now let me introduce the keynotes, Mr. David Blood. He's a co-founder, along with US Vice President Al Gore, of Generation Investment Management, which is a firm which is dedicated to strengthening the field of, and here I'm very interested to see how you define this, sustainable capitalism. Usually we talk about sustainable finance, here we talk about sustainable capitalism. Maybe it's your past as a co-CEO of Goldman Sachs Asset Management, which has led you to introduce this very interesting notion of sustainable capitalism. We understand that the focus is on long term. It's with criteria known as environmental, social, and corporate governance, so the famous ESG criteria. So you're not going to talk about Generation Foundation. If you want to address the issue, we can do so at the Q&A or during the cocktail. But basically, it will be a lecture on how you see sustainable finance, and we're very interested to hear about your views on the subject. David, and the floor is yours.
Good evening, everyone. You could say good evening back, but no. I thought I would just explain how it is that I came to be here, because it was actually more by accident than by plan. It turns out that so actually Lucas was saying, how is it that you came to be interested in sustainability, having been a partner from Goldman Sachs? And it turns out that that's a fair question. And I said, well, actually, I've been thinking about this probably since I was 11 or 12 years old. And in fact, when I went to university, I thought I was going to do one of three things. I was either going to be a social worker, a forest ranger, or a teacher. And so I went to this small college in upstate New York, and the one discipline that they clearly had was education. So I decided I was going to be a teacher when I was 18 years old. And when I was 19 years old, I learned, as a surprise actually, that they had discontinued the education department at Hamilton College. So I had to look around for a new focus, a new major, and I chose child psychology. Now, I will tell you that having managed investment bankers and anyway, you get the idea. In child psychology, it turns out, was in fact the right thing for me to study. So anyway, I was getting towards graduation, and my father said, you know, you need to get a job. And I said, no worries, I have this covered. So I applied to get my doctorate in psychology, and I was rejected. So then I thought, well, I better do something else, and so I applied to the Peace Corps, and I was rejected. Now, you have to understand the Peace Corps is a volunteer organization. So getting rejected was really kind of a tough blow, I must tell you. So then I thought, well, I'll just go back home. And my father said, no, that's not going to happen. He said, you should considered joining a bank. And at that time, this was 1981, almost 35 years ago, in the United States, a number of the banks had these bank training programs where they would try to train people like myself and in finance. And so I applied to 70 banks in the United States in 1981, and I was rejected by 69 of them. But I did get one yes, and that's how I'm here this evening, as it happens. Now, fortunately, it turns out I guess I was okay in finance, and I did have a career at Goldman Sachs and then ultimately in founding Generation. And if I could just give you two points of my background since not being accepted the Peace Corps. One is now I've been in finance for 35 years, and as I mentioned, I was at Goldman Sachs, and it turns out there's not that many socialists at Goldman Sachs. And so getting into sustainability is a little bit unusual, and I'm going to explain why. And I've also been very blessed to be able to be involved in philanthropy now for almost 20 years, including doing on the board of a number of different philanthropic organizations, including some investment committees of some very large philanthropic organizations around the world. So I bring today both finance experience as well as philanthropic experience, as well as actually personal philanthropic experiences. So a couple of broader definitions before I make the business case for sustainable investing and make a couple of observations around that. The first is when we think about investing, and we talk about investing this evening, you can think about it in one of two ways. You can think about it as trading, or you can think about it as long-term investing. Now, actually, there's a place in portfolios for trading, but what we want to talk about is long-term investing. And as soon as you make the decision that you would like to be a long-term investor, your horizon needs to change. Your framework needs to change. If you're trading, then your time horizon is going to be quite short, certainly less than a year, and could be as little as 24 hours or less. But if you're investing for the long term, you need to have, as I said, a broader framework, a deeper framework of how you're thinking about businesses. And if you look at any corporate finance book or any investment book, they will tell you actually that both investing and trading is hard, but investing for the long term is best practice. And what we discovered when we founded Generation 12 years ago, and actually what I knew very clearly over the course of these last 30-something years, is that the market has become very short-term oriented as opposed to long-term oriented, and that has been a problem. And that's been a problem for finance, that's been a problem for politics, that's been a problem for economics. And so when we think about investing, we're deliberately and very categorically thinking about the long term. Secondly, when we talk about sustainability, we do include a broad array of questions. Oftentimes people think of it as just the environment, just clean tech investing. That is certainly not the only aspect of sustainability. There's a number of environmental factors. There's also a number of social factors. There are the governance questions, but also there's other long-term economic and geopolitical trends, drivers of change that need to be considered. And in fact, one of the reasons why we think about sustainability in a long-term investment portfolio is that the context of business is changing and in fact has changed. And it's been very clear that that's been a trend, a direction of travel, certainly over the last 15 or 20 years. And let me just give you a couple of examples. For example, the challenges of climate change, or the challenges of health, or the challenges of water, or demographics, or poverty. These challenges have become more acute and actually more interlinked. And therefore, the solutions to these challenges have needed to be thought of in a different way. And that context has ultimately affected businesses because civil society, philanthropy, as well as government probably do not have enough money or the tools to solve those challenges, and therefore business is going to need to be part of that. Communication, the speed of communication has also changed the context of how people think about investing. The generational changes that we are seeing in people's perspective on millennials versus baby boomers and their expectations are all part of this broader context of business that is changing. And therefore frameworks, investment frameworks, need to be thought of differently than what they have been in the past. And in fact, just to give you another example, if you believe that climate change is real and that we're going to need to transition to a low-carbon economy very rapidly over the next 5 to 10 years, then you need to take a step back and say, in my investment frameworks that I have been working with over these last 30 or 40 years, will those frameworks need to change? Will the energy complex that makes up a significant percentage of investable assets, although it's a smaller percentage today than it was a year ago or 2 years ago, is that still the same framework? And I think most people would say, no, actually we might need to think of a different framework for that. And we can come back to this if it's of interest. So a couple of other definitions. There's a continuum now of what people think about in terms of sustainable investing. Historically, what people have said is sustainable investing is SRI, socially responsible investing, or ethical investing. And let's just use the word ethical for a moment. What that implies, socially responsible investing, ethical investing implies, is that there are certain categories of businesses or investments that ethically you're uncomfortable with. So for example, arms companies or alcohol companies or tobacco companies, those could all be exclusions that you would be uncomfortable investing in as either a fiduciary, in some cases, church groups for example, or as an individual. So the notion of a negative screen is really the idea around ethical investing or socially responsible investing. Now the challenge with that definition, in our judgment, is that that is a perfectly legitimate approach, particularly for individuals, but the challenge is, of course, that if you decide to eliminate certain in asset classes, the conventional wisdom is that you are limiting your opportunity set and you're limiting your ability to deliver returns. And so historically, SRI, ethical investing, has been rejected by the broader investment community as being a violation of fiduciary duty, in fact. So sustainable investing up until 15 years ago was really a niche. It was a niche that was, I again continue to believe, an important perspective, but it was going to be a narrow perspective. And then probably about 15 years ago, a second type of, and by the way, ethical investing goes back for hundreds of years, actually, but let's leave that aside for the moment. There then became a point of view that, well, wait, what we should do is we should not eliminate any asset or any investment type, but what we should do is create an index that mirrors the world indices or the whatever index you might want to think about as an investor, that mirrors those indices, but selects the very best companies within those industries from a sustainability perspective, a checklist of sustainability challenges. So the Dow Jones Sustainability Index, as an example, or the FTSE for Good Index, are examples of best-in-class indices, sustainable indices. And in fact, there were a greater number of investors who would deploy against those indices, particularly given those who've made a decision that they want to have certain index products versus active products. But the problem with those indices, and still exists, is that it's really very difficult to use a checklist to grade a series of companies, whether they be for bonds or equities or any other type of asset class. And so that investment category, the indices, has also probably not been as successful as people might have hoped. So when we began to think about this problem, knowing that the context of business was changing, knowing that long-term investing meant that you needed to think more holistically, and knowing, and this is a key insight which I'll talk about here in a minute, that businesses actually ultimately are driven, their success is driven by a more holistic assessment of environmental and social governance factors, we concluded that the way to think about sustainable investing is to integrate sustainability, broadly defined, and we are not going to prescribe what you should think about it. We include a number of different factors in terms of how we think about analyzing quality business and quality management, but we integrate sustainability into our investment processes because we think it gives us a better lens to make investment decisions. So for us, sustainability is not a trade-off of values for value. In fact, it's just the opposite. It's a strong conviction that if you're a long-term investor, you need to be holistic in understanding the economics and the prospects of those businesses. And therefore, there's no question that you shouldn't ask as long as you think it's relevant to the long-term success of business. So sustainable investing in our minds is best practice. It's not a trade-off. It's not something that you do because you like to do it or it's nice to have. It's actually quite fundamentally relevant to the long-term success of business. So why do we say that? What is the business case for sustainable investing? One, as I mentioned earlier, the context of business is changing. The drivers of change that we're facing as investors, as business people, as capital markets professionals, as regulators, that is fundamentally changing, and new investment constructs need to be considered. Point two is that if you look at the history of investing, if you look at the history of businesses, there are really three aspects of sustainability that can be useful guides to making either a good business decision or a good investment decision. The first is risk management. It turns out that sustainability, the lens of sustainability, is a very important guide to understanding the potential reputation challenges of a company or the potential litigation challenges of a company or brand diminution challenges of a company. So I'll give you a very live example. Valeant, which is a US pharmaceutical business, their fundamental business premise is to buy sort of out of favor drugs, but are still quite critical to health questions, and raise the price. That's their entire business strategy, and actually to leverage that up. And we have felt that that is not a very smart way to run a company, and we felt that it was ethically challenged. And now, of course, as you've seen in the press, there's significant challenge around that company. The stock is down 60% in the last, really in the last 2 or 3 months. Volkswagen, another example. It's under what circumstance could you ever imagine that you would cheat on different environmental regulations? But if you understood the governance of Volkswagen, you wouldn't be that surprised at it. And it's these sorts of questions, not to say that we always get it right, by the way, because we do not. But the lens of risk management, brand management, that sustainability affords you is a very important tool to investing. And there's an old adage is that great investors avoid great mistakes. We're certainly not saying that we're a great investor, but if you can avoid great mistakes as an investor, which sustainability helps you do, that's a really good thing. The second business case is we know we're living in a resource-constrained world. We know that. And therefore, if you can find businesses that are addressing that challenge and actually are recognizing that challenge within their own business model, then you can, number one, that's a lens on management quality, but number two, they are anticipating significant challenges. And so if you can reduce your carbon footprint as a business, as an example, almost always that will result in lower costs for your business, certainly over time. And therefore, resource constraint and managing that resource constraint, particularly in the world that we live in and will be living in, is a really important tool to find better businesses. And lastly, it's the notion that if you can find companies that uses their products and services to address real needs, real sustainability challenges, that's a very, very powerful business model. A very powerful business model. And that's ultimately the holy grail of sustainable investing, is using that sustainability lens to try to identify companies and business strategies that are addressing these broader challenges, these broader drivers of change challenges that we see. Which then brings me to the conclusion that I want to make around sustainable investing, and then we can open it up to questions and most importantly get to the panel. Sustainable investing, let me be very, very clear. It is not about imposing our values on the portfolio. It's about common sense. It's about understanding what drives the long-term success of businesses. And it's clear to us that sustainability is integral to the long-term success of business and allows us to make better decisions. Now, if you believe that, there are two further points that you need to consider. The first is whether sustainability in your investing thinking, your investment process, should be separate. If you believe that sustainability is best practice and that it's a critical component of business success, then you should not have two teams or two philosophies, or you should not go to a company or an investment strategy that has a global equity strategy and a sustainable global equity strategy. If an organization thinks of it in two separate ways, they don't get it. They think that sustainability is nice to have. And if you're thinking about sustainability from your own portfolio perspective, it's best to think about it as an integral and integrated part. Secondly is around fiduciary responsibility. Oftentimes people will say, well, I'm not sure we can consider sustainability because it's a violation of our fiduciary duty. If you believe, and the evidence is now very clear from our perspective, that sustainability drives the long-term success for business, then therefore it is your fiduciary duty to integrate sustainability and insist that your managers use sustainability as a part and parcel or as a tool to make investment decisions. So the business case for sustainable investing in our judgment, and certainly has become so over the last 10, 12 years that we've been at it, is extremely robust, and it's about economics. It's not about ethics, it's about economics. Now, one last thing I want to say before I turn it over to questions is there's a new genre that is emerging that is really quite relevant to foundations and endowments, and indeed to private individuals and wealthy families, and that's around impact investing. And impact investing is very new. It is confusing to many, but let me just try to give you a little bit of a sense of what we think about impact investing. Impact investing actually doesn't necessarily have to have a trade-off. So for example, we have a strategy that is investing in businesses that are part of the transition to a low carbon economy, we set out as an investment objective that we will deliver great results from that, but that we'll have significant climate impact. There's no trade-off. That's an impact investing strategy. However, there's other impact investing strategies, and it's not always the environment. They can be social challenges, where you make a decision as an investor that you are prepared to take a lower return. So if you look at an asset class and you say, well, the right return for this particular asset class is 10%, say, and you say, well, I know that the impact of this company or this project is so important to alleviating poverty, as an example, and I can measure that, then I'm prepared to give up 2% of my 10% returns or 20% of that return because it's worth it for the impact that I'm having. There are some who will say, actually, if you just give me my money back and you're using my money to create impact, that's worth doing. And you can actually make a further argument that if you are developing your own asset allocation, those sorts of asset ideas tend to be not correlated to market correlations or market circumstances, and that actually can be good for your portfolio. So that's a long way of saying that when people start talking about impact, it means a lot of things to a lot of different people. But the one important nuance always comes back to, is it affecting a challenge? Is it addressing a challenge? And importantly, how can we measure it? And that's how I will close, is to say that when we think about impact investing, the one thing that we know that needs to be much sharper and better is how you measure it and how you report on it. And that is still very, very early days. Now, I think that impact investing will be an important tool for particularly foundations and wealth management circumstances and individuals, but it's early days and there's still a lot of work that needs to be done on that. And the definition of what impact you're having is one of the most critical questions associated with that. So I think I'll leave it there, and I think we have maybe 5-10 minutes for questions before we get to the panel. I guess since this is sort of a university, I can call on people. Or the moderators are calling on you. Yes, I can't. I actually can't see, so you're all going to have to police yourselves.
Thank you very, very much. That was absolutely fascinating. I was especially intrigued by what I see as a possible paradox of the American style of developing, of investing, which is short view, and what you plead as being a necessity for sustainable development of being long view. So my first question is, how do you, or did I understand you right, and how do you tackle this issue? My second question, if I may, is another paradox is China. The whole planet is turning away from coal and nuclear energy, and they are running to it. How do you suggest solving those issues?
Okay. The first is we do think that sustainability, so if I understand your perspective and questions properly, we think that sustainability is critical to long-term investing. And there are important long-term investors around the world. It's not just a European thing or an Australian thing or an American thing. There's lots of naturally long-term investors. What's happened, unfortunately, particularly in the United States or the UK, is that that folks have forgotten what best practice is. And so we have spent a lot of time over these last 10 years is reminding people that long-term investing is best practice, and here's why. And all you have to do is think about Warren Buffett, who's perceived to be among the best investors in history. He will tell you that his preferred holding period is forever. So we know that long-term investing is best practice. Now, I will also tell you that we've been at this for 10 years, and our 10-year track record is really good. And in fact, I can give all the speeches I want and even be articulate once in a while. But if we are not able to deliver outstanding investment results, then our words mean nothing. And so we're not confused by that. We are very focused on using these tools to prove the investment case, to prove the business case. And while 10 years do not prove the skill for sure, it's a good start. And we've been fortunate to, with some luck, I'm sure, but we've been able to use our sustainability tools to demonstrate that this is a very smart way to invest. And the more that people see that, the more likely it is that people will follow it. On China, now unfortunately today, you may have seen in the newspapers, the Chinese have acknowledged that actually they have used much more coal than they thought they had, or they had previously disclosed. And yet, I think you mentioned that they are trying they're moving even more aggressively into coal. That's actually not true. And the reason why that's not true is that China, if you look at any of the pictures around what's happening in the major cities in China, it's not a very pleasant place to be. And the Chinese officials know it. And in fact, it's a huge health challenge. One of the things that we think about in terms of the transition to low carbon economy is as we move away from the science and actually start talking about, well, what are the impacts? There's significant economic impacts, which we think are very positive. But importantly, there's important health impacts. And if you think about the whole health question around the transition to low carbon economy, moving away from burning coal because it is truly terrible, or kerosene in Africa, et cetera, these are important and valid reasons to accelerate the transition to a low carbon economy in and of themselves, even before you get to the climate change issue. Yes?
You didn't at all associated the sustainable investment with developing countries. We are a Swiss sustainable project, so I thank you for that. But it seems that today is in most people's mind, sustainability investment or impact investment is most likely related to a project in developing countries where control and check is questionable at best. Why do you think that is the case, and do you think that will change?
So is your point that you think that a number of businesses and companies in the developing world are not sustainable?
No, I'm saying that people that want to do sustainable investment or impact investment are focusing mostly on projects in developing countries where they think that they will have a real impact. And I'm saying that there is plenty of projects, sustainable project and impact project in all parts of the world where the focus seems to be much smaller.
Well, we would definitely agree with your point of view that sustainability investing and impact investing is a global opportunity and a global challenge for sure. And in fact, you could argue that in some circumstances, particularly as it relates to measuring, and some basic governance frameworks, it's more difficult to invest in the emerging markets. Now, yet there's significant need to do that, and I think one of the big challenges around Paris is not the outcome of whether Paris will be successful or not. We think Paris will be successful, but in fact, the real question is how will we begin to mobilize the capital, particularly to the developing world, that will need to be mobilized for us to make this transition. So that's a long way of saying we think that the emerging world is extraordinarily important, but we strongly agree with you that impact investing and sustainable investing is equally relevant and important in Switzerland or in Europe or in the United States. I think the official moderator is saying that it's time to do something much more interesting than listen to me talk, is actually bring more thoughtful people to the stage. So thank you.
Yep. Yeah, microphone, or is this one? Well, as I said, you will have more opportunities to ask questions. So we have about half an hour as a round table, and then we leave it for sort of 5-10 minutes in the end, so that you also have the opportunity to ask questions to the panelists. Before we start, I'd like to introduce, I mean, we know now David Blood. I'd like to introduce my neighbor, Lucas. He started his career in a small private bank in Basel. And then in 2004, I believe, he became a president of a Stiftung, a foundation called Velux. And they engage into health projects, how do you call this? Aging in a healthy aging, that's correct. And more importantly, he's just become, when we started the programming of this conference, he was not yet president, but in the meantime, he has become president of Swiss Foundation, which is the Association of Swiss Grant-Giving Foundations. And in that head, he heads the finance department, or the finance group. So he thinks a lot in terms of asset management, impact investing, and sustainable finance. Next to him is Thierry Lombard. I believe there's no need to be lengthy about presenting Mr. Lombard. He's a private banker, sixth generation private banker, former private banker, retired private banker from Lombard-Odier, which he joined in 1972. And his specialization is investment management, asset management, institutional asset management, and with a focus on investment strategy. So that's interesting to us. And he has a passion for family business. He was president of a Family Business Network International, with about 8,000 family business united in there. Very engaged in philanthropic activities. He's the president of Lombard-Odier Foundation and Philanthropia, which is a hosting of other foundations who come here in Switzerland. Okay, so to start the debate, well, you should know that there are 13,000 foundations in Switzerland and 20,000 in Germany. So, but there are 8 million people in Switzerland and 80 million in Germany. So the density of foundations in Switzerland per habitant, the number of foundations per habitant, is 7 times higher than in Germany. So lots and lots and lots of foundations. So this is, we'll talk about when we talk about issues and challenges, clearly an issue. Maybe we have too many foundations, and we should maybe foster a concentration of these foundations that very often, more often than not, pursue very similar goals. If there is one institution which should clearly manage its wealth according to SRI, it's the foundations, which clearly, I mean, amongst these 13,000 I mentioned, there are about 8,000 in Switzerland which follow charitable goals. So clearly, I mean, when you talk about investing, the why and how of responsible investing for foundation, it should be just tautology, right? If you're a foundation, especially if you follow charitable goals, then it should be clear that your managing of the investment should be done according to rules of SRI. Yet, we find that when we look at what we call the mission-related investment, i.e. wealth management of the foundation, which is done in accordance with the foundation missions, we find out that in Switzerland about 69% of the foundation know the concept, but only 11% do apply MRI, so mission-related investment, in practice. And this is a broader realizations that we can make of, it's a hard fact, unfortunately, of Switzerland. We talk a lot about sustainable finance, and we've been doing so for many, many years. And yet, there is on and on this same conclusion which is drawn that people talk a lot about sustainable investing, but then when it comes to actually do and go into practicing sustainable investing according to this criteria, then we find that the proportion of wealth of, say, pension funds or foundation invested with this style, and then we can talk about your argument, which I think is very important, is indeed very low. So, a question, a long introduction, but just to throw a question to you, what could be the reasons for this dichotomy between knowing a lot of sustainable finance and doing little? One possible explanation for this is lack of knowledge. So, Lucas, when I turn to you, when here in Geneva, this argument does not sound very credible, because indeed there's a lot of knowledge about this, but you have a different point of view for the rest of Switzerland.
Thank you very much. First of all, I want to correct a little bit the introduction, which was very kind, too kind a little bit, because I'm not yet president of Swiss Foundation.
Oh, sorry. Mara,
only in half a year, and I'm only the director of the Velux Foundation and not the president, but
okay.
These are details. Okay, thank you. To your questions, first of all, a figure that is always very impressive. You have the estimated endowment of Swiss grant-making foundations is about 70 billion Swiss francs. The whole amount invested in sustainable investments in Switzerland is also about 70 billion Swiss francs. So it's the same amount, but of course all the sustainable investments are distributed over all investors, private investors as pension funds, as whoever. So we can see that by far not all foundations are really invested in sustainable investments. I also doubt a little bit these kind of studies you quoted, because normally foundations answer these questionnaires who are already interested or involved in these kind of subjects. So I would guess that the rate of foundations really involved in sustainable investments or even mission-related investments is much smaller.
So it's even lower than what I said.
Yeah, it's well, much lower. I would say it's a
okay.
If you take impact investing in a narrower sense, it's
even lower than 11%.
Yeah, it's lower, certainly.
Gosh.
It's
okay.
rather towards 0 than towards 11%. I would say. Just a personal impression.
All right.
The reason information, that's certainly one thing. I would not say that the information is not available. In the last years, a lot of information has been distributed. The financial sector has provided a lot of information, a lot of instruments also to invest in these kind of investments. But I would say that the interest of the foundation is not really evolved, at least in Switzerland. Right. Foundations normally, if you look at the classical foundation of the Swiss style, you have a board who is very dedicated to the purpose of this foundation. You have probably one board member who does the asset management stuff, right. And everybody is interested to do as much as possible in the funding area, but is not really interested in the finance. So you are happy if somebody really takes care of the assets, and you don't really think about how he does it. And this is, I would say, still the rule in most of the foundations.
You also allude to another thing which is, I think, part and parcel of the culture in philanthropy in Switzerland, is that we have this culture here of doing good and not talk about it. So this is changing, but in your view, too slowly, right? And this lack of communication, this lack of transparency makes it, for instance, that we have all these foundations pursuing the same goals and not talking with one another. So not sharing any thoughts they might have on sustainable investing and how good it is. Well, we'll come back to this point, but there's a lot of work for you as the next director of Swiss Foundation to embark in knowledge transfer and increase that, enhance this transparency.
Well, that's actually what we already do,
yes.
But we are a quite small association. If
right.
you look at the 8,000 foundations in Switzerland, we have 130 members. Yep. So the leading members, of course, but it's not a bigger part.
All right. Thierry, we know that foundations generally manage their wealth in a very prudent way. Typically, if they go for apply to a bank for having a mandate, it would be a balance and possibly even less risky than a balanced portfolio. So maybe a conservative with a lot of bonds and few equities. So there's this idea, which is wrong because things have evolved, that the lack of follow-through, the fact that these foundations are so little invested in sustainable finance products is because they have a small culture of equity investing anyhow. But as I said, this is a false argument because over the years, and I talked that with a specialist of sustainable finance at your bank, he said the range of products is now widened, and now we may even, the largest asset class in the sustainable finance is actually bonds. It's not equities. But what is, in your view, when you have the experience of a banker specializing in investment strategy, asset allocation, a reason you alluded in our prior discussions to the fact that maybe some of these foundations are excessively diversified. You mentioned this idea of excessive diversification, which may explain why there has been so little value creation for the foundations when they inherited the capital from their founders, which were somehow more successful than the banker in going from wealth preservation to wealth creation. Is this a correct statement?
There are many points on your comments. I think the first point I would just mention is really David comments and our history. Where are we coming from and where are we heading? And we have lived during period of negative screening, which didn't prove to really add value and or add performance. And fortunately today, I think the best element is really the absence of trade-off, the capacity to invest in creating value and creating performance, but because you're adding a responsible analysis on social, environmental, and many other elements. And I think Generation has this nice way of saying that, you know, for lights and or for sound, we all hear and we all see some lights, but there are other lights we don't see. And I think in investments, if we can add the many things which we don't see directly or we don't hear, but which are important long term, I think it will help and continue to develop more capacity to convince really board members and or foundation to continue to go towards sustainable investment. I think the second element I would say, and I would not make a joke, but I think my grandchildren, for the very small portfolio they are the ideal investor in sustainable investment. First, because they don't ask any questions. Secondly, because you can put more sustainable investment in their portfolio than for any other clients. And third, because I really think that medium to long term is the best investment you can do for them and for their future. So we have also a generation gap today, and younger, I think, board members and or people realizing and really understanding what it means to build the future. And I think the third comment I would say is that, you know, sometimes we're still working within foundation with numbers and with percentage. And we are just talking about, you know, the index or the market are down 10%. We have been great investors because we are down 8% or 5%. At the end of the day, we have to realize that in order to make and to have a bigger impact for the future, we have first to learn from the mistake of the last 10 or 15 years, and for the destruction of value we have had being on pension funds, being on foundation, because of a very difficult period of 2007 and 2008. And secondly, we have to keep some capacity to take calculated long-term risk in the way we invest. Because if we want to continue to serve the objective of the foundation, being or employee for a pension fund, or being, you know, humanitarian, social, or environmental foundation, we need to create wealth, and not only to preserve wealth. And that's also where we need the performance of a good, sustainable strategy for the future.
Yes, okay, thank you. There's one other argument that you hear sometimes for people justifying their lack of follow-through in investing in sustainable finance, and it's the fact that we don't know how to measure impact. David, you mentioned impact investing, and there's a lot of thinking in that, also in the academia, to really quantify and the impact. But the argument for not going into SRI type of investment it seems to me a bit fake, in that it sounds as if, okay, I know what the impact is of doing non-ethical investments. You know, I don't know, buying, the Vice Fund. Maybe you're familiar with the with their activities, and so you know how to measure those nasty impacts, and so you invest in those, and you don't really know how to measure the impacts of positive investment like sustainable finance, and so you don't invest. So it seems a bit of a fake argument, would you say?
Yes, we would agree with that. And actually, increasingly, there are measures. So, for example, it's not at all unusual to measure your carbon footprint within your portfolios. There's now a number of indices and a number of very important large investors who are specifically analyzing their managers' carbon footprint relative to other managers. So the Environmental Agency, for example, in the UK, when we do a portfolio review, they insist that we present our results, and then they will grade us relative to the carbon intensity of our portfolio, relative to the index and relative to others. So there is measurement now going on. I think it's harder to measure, and you can measure governance too, actually. It's harder to measure social impact, but even there's tools, increasingly tools to do it. I guess I sound like a broken record. Those are things that you actually play music on. Actually, for those of you who don't know that, you should listen to them. They're actually quite good. But as a broken record, it really is. It's confusing to me when someone says, "Well, we don't think that we should." How do you know? So when we founded Generation, people said, "Well, how do you know that your strategy will add value? Have you back tested it?" And the answer is no. We're not going to waste any time on that. And we think that ultimately including these factors will allow us to make better investment decisions. And can you tell me, person who's asking me this question, why you think it's better to ignore how you attract and retain your employees? Or why do you think it's better to ignore ethics? Why do you think it's better to ignore culture and governance? If you think that will make you a better investor, then go ahead. But there's no evidence that says being unsustainable is a good way to manage a portfolio.
Indeed, yes. And there's a further argument, still always to try to explain why so little is done in terms of action for investing along these criteria. And the argument, as the argument runs, is that sustainable investing generates poorer return if we compare those to traditional investments. So the subject comes back regularly, or the issue, is there a premium to pay for being sustainable, which detracts from performance and make it that these investments underperform traditional ones? Well, I saw a piece of research from Mercer that did a survey of all the academic research and on this issue of performance of SRI. And they did 36 studies, and 20 of them came to the conclusion that there was indeed a positive relation between SRI and performance. 2 were neutral to positive, 8 were neutral, and only 3 were negative to neutral. So only 6 of these 36 studies were pointing towards the conclusion, which is often the a priori that we have, is that there's a premium to pay for being sustainable, and hence it detracts from the returns. Would this be, Lucas, the kind of argument that you hear from foundations you talk to, that they say, we don't really want to invest in this asset class?
Absolutely. I think this is still in the heads of the people that you pay more fees, you have a lower performance with sustainable investments because you reduce the universe, the investment universe, you take more risks, therefore this harms your performance finally. I think this is one of the arguments you said, and I think that the issue behind this is the main issue, which means that there are so many arguments against sustainable investments that in every board you just have to start the discussion, and then you have a lot of you have a wall in front of you of arguments, of doubts, of worries that if you start investing in sustainable investments, you could make a mistake. And therefore the discussions, at least as I can say, when we started these kind of discussions in our foundation 8 years ago, the discussions stranded. They didn't follow up finally because there were so many. And it was never the question, as you say, David, what is wrong about investing sustainable? Because you cannot do any mistake if you avoid harmful investments, particularly as a foundation, which has a charitable purpose normally, which has a founder who gave us the duty or the mandate to maximize the impact of the foundation. If you don't take care of the assets, you reduce this impact finally. You can do your best work on the funding strategy, but you have less impact because you neglect your asset impact. And therefore, it's as you say, it's a fiduciary duty to take care as well of the endowments and what you create on impact with your endowments. But this logic is not really broadly distributed. It now comes in with the new Swiss Foundation Code, which is presented these days. And there the shift of paradigm happens, that foundations should, that it is best practice to also take care of the impact of the endowment.
Okay. Thierry, would you have something to add in this respect of underperforming?
A good collaboration between the University of Geneva and the foundation and our Swiss Foundation. I think we still, are all learning, and we need really to train board members to make them more confident and more at ease with what sustainable investing is, how to find the right firm individuals who can help them, how to be more responsible towards the assets and or the results of these assets. So I think without trying all together to really move one step further to where we are today, I think it's going to take too much time. So I think we should at one point maybe make the list of the elements which are for the time slowing the process. And is there anything one can do, each of us with our different hats, to try to mitigate and or find solution for the slowing process in going towards more sustainable investment for the future.
Okay. And now to the last point, before we open the floor to your questions, the audience. I very much like what you said, David, that SRI should be best practice and should be part and parcel of investing and not a separate asset class or a different style. And I want you to tell you a revealing anecdote in this regard. I once attended a conference given by a very famous hedge fund manager here in Geneva, along with a person, I think I saw her coming in the room, she will recognize herself. She founded Sustainable, trying to get it right, Sustainable Finance Geneva, SFG, which then became Swiss Sustainable Finance. So we both attended the conference of this very famous hedge fund manager. His conference was all about performance and driving this excellent return. And when he ended his conference, he came down from stage, and there were lots of people around him giving his business card. And I noticed that he had a very shrewd technique. He would listen very vaguely to what someone had to say, and then take his card, and if it sounded interesting, it would go in one pocket. And if it sounded a bit boring, it would go in another one, right? So, and this person I was with said, oh, suddenly she said, she threw it at him, what about sustainable finance? And he stopped and looked back and he said, oh, yeah, it's interesting, but you don't make money for your clients with that. And the card went on the boring pocket. And so I said, no, don't tell him it's a different style. Just mention Warren Buffett. And I was very pleased that you mentioned Warren Buffett. And that you do think Warren Buffett, he has a say, if you want to make an investment in General Motors and you want to buy $200 of the shares of GM, you should do that with the same intensity and same work as if you were planning to buy the whole company. So you just say, you know, it's long-run investing, a la Warren Buffett. So she threw Warren Buffett in, and then he stopped, came back, took the business card, really, out of the pocket, put it on a different one, gave his business card, and say, come to my office and talk about what you do in the field of sustainable finance. So she went. In the end, nothing happened. But at least he got interested in the concept. The minute you stopped saying that it's a different style. So, just to be a bit provocative, should we stop having conferences on sustainable investing and treat it as a separate asset class? Should we be just say, you know, this is part and parcel of investing and include it in traditional investing?
Well, I think the business case, and this is new over the course of the last 5 years, and certainly over the last 10 years, the business case for sustainable investing is extremely robust. We have a lot of data points. Every day you read the paper, you see more data points, and that's extremely useful. And there's not just generation who's making this perspective. Michael Porter from Harvard Business School does. Don McBarton from McKinsey would make the same point. So there are a lot of very thoughtful, more thoughtful than ourselves making this point. What we would like to pivot to is not so much the why, but actually the how. That's the area that needs to be probably discussed and having conferences about. It's not so much why sustainability makes sense. I think that's pretty clear. But how do you do it across asset classes? How do you think about the implementation? How do you think about the measurement? Those are fair enough questions that need to be flushed out. And so I hope that in 5 years or 10 years' time, we're meeting on something other than just the how of sustainability. But I think for the foreseeable future, we're going to need to really drive home how do you go do that as opposed to why do it.
Yes, you were referring to your grandchildren. They won't tell themselves they are investing in sustainable finance, right? They're just investing, right?
Well, they have, you know, the pleasure of having the next 80 years or 90 years to find out how important it was to invest in sustainable investment.
Okay.
And the power of time. You know, David was mentioning the long term. Long term, you know, is a fantastic power. I just had a friend at a small private equity firm, and he had this fantastic saying that when he entered the business 40 years or 50 years ago, he was in the storage business as an investor. And when he left his business, he was in the moving business. And you know, we all have to go back to the storage business and the responsibility of the long term, because the moving is not creating any value.
Okay. Okay, so I suggest that we open the floor for your questions or comments or anything you'd like to say.
Hi, thank you for all coming. It was a great discussion. My question is, I worked in a really big bank this summer, and I tried to raise the question of sustainable investing, and I was just an intern, so obviously I had no one listened to me, and it was quite sad. And the way they saw it was, like you said, David, separate. They had like maybe one fund about sustainable investing. And my question is, I'm about to enter the workforce into banking. What can I do to like make this change? You know, be your grandchildren, or, you know, what can I do?
Well, I'm sure my colleagues will have a perspective on this as well. I think, first of all, you can insist that the organization that you work with does consider sustainability. And increasingly, there are groups of young finance professionals who are focused on this. And the reason for it, again, is best practice. Now, one question might be, well, why didn't, if I was the CEO of Goldman Sachs Asset Management, why didn't I just change Goldman Sachs Asset Management as opposed to starting afresh? And it is hard. Big organizations, it does take time. But all the major firms are beginning to talk about this. Some are further ahead than others. And what I would advise you to do is to figure out which of these firms are ahead of the others and go focus on them as opposed to those who are laggards. And I did the same thing. In 1985, when I joined Goldman Sachs, I actually did an analysis of each of the major investment banks to try to figure out which firms I thought had the best culture, because I thought culture would be an indicator of success. And it turns out it was. In the time of today versus 1985, probably 10 investment banks that we're actively interviewing, maybe 15, are out of business. Why? Because of failures of culture and failures of sustainability. So you have a right to do that, and I would actually advise you to do it.
Okay. Another question?
David, please help me resolve a paradox. If we say that there's a business case for sustainable investments, or if we say that there's no trade-off between returns and sustainability, why do you think do we need to try to convince investors or analysts or asset managers? These are all smart brains. They would spot the opportunity instantly.
Well, increasingly they are, but the reason that they haven't historically is actually what Terry said a while ago, is that the history of sustainable investing was a more difficult one. And this is particularly true in the United States, but it's true everywhere. The question around SRI or ethical investing, there were a number of firms who did that, and their investment results were not all that special, actually, not that interesting. And so the perception is, and we even on this stage have used, some of us use ethical investing, some of us use sustainable investing, some of us use SRI. That's really confusing for folks. And the words that you use actually will come up with an image in many people's minds. And SRI, ethical investing, particularly with sophisticated people, will actually have a negative implication just off the bat. And then you have to then say, well, actually, here's what the difference is. And the reason why I walk through the difference in my remarks is that it's important to know the differences. And it's important to say, then here's what we're doing, and here's why we're doing it, and then give company examples as to what's going on. And this is an advantage I think I have in the conversation. As I said earlier, there are not that many socialists at Goldman Sachs. And I can have a very rigorous conversation with whatever hedge fund manager that you want to talk about, or whatever investment professional you want to talk about, because I've been doing this for 35 years. And I have a real depth of experience and case studies to make the case. Now, investing is hard, and there's different perspectives, but ultimately it comes down to rigor. It comes down to what makes sense. And today I will tell you that the ability to make a robust statement and pushback for someone who says, well, I don't think it adds value, it's simple. It's dead simple. All you have to do is read the paper today or yesterday, and you'll see that it's very simple.
Good evening. My name's Ian Henderson. I work for the UNET Finance Initiative. We had our AGM about a week ago, and we had the CEO of Hermes Investment Management speak. And he talked about their incentive strategy. And this is picking up, David, on your point of culture. He said that they've just changed their incentive structure, and it's now 50% based on traditional performance metrics, but it's 50% based on being, as he described, a good person. And I worked in investment banking for 10, 12 years, and we were told that there were all these other KPIs that we were going to be measured against. And it came to, you know, your performance review day, and the conversation always came back to short-term P&L. So my question to David and any of the other panelists is, what have you done, what can you do to change the culture internally? Have you got any anecdotes, any insights that you could shed on how you've incentivize your employees to embrace this long-term philosophy?
Well, there's a couple of things. The first thing is we said to our clients that we were going to be very long-term oriented and that we were going to evaluate ourselves, and they should evaluate us, and they should compensate us on a long-term horizon. So our fee structures are 3 years or longer in terms of how we earn our economics and our profits, actually. And then we, in fact, evaluate our team on that very same basis. And so if you say we're going to be long-term and you evaluate somebody on a quarterly basis, that's an inconsistency. If you say you're long-term and you create incentive structures and fee structures that are long-term, that goes a long ways to it. And then secondly, and I know, by the way, that investment banks are very good at telling you that you need to do recruiting or X, Y, and Z, and then when they come down to review, you're going to be evaluating something else. That's a cultural problem, ultimately, and that's quite disturbing, actually, and that was some of the work that I did way back when I was looking at different firms. And one of the reasons why I decided to retire from Goldman Sachs was, in fact, the change in culture. But the last point I want to make, and just I keep hitting at it, is I don't think that sustainability is a non-financial factor. I believe that sustainability is a financial factor. It is about finance. It's not something separate. That's true for every qualitative aspect of how you evaluate a business. And you know that businesses trade on something other than what the balance sheet says. Trade on earnings potential, discounts of future cash flows. What determines future cash flows are market share, is culture, and these are financial factors.
Right.
That's why they can't be separated. And when somebody says, well, you've outperformed over these years, what percentage of your outperformance is because you just were a good stock picker, and what percent was because of sustainability? And we say, we make no effort to decide. We think it's exactly the same issue.
Yeah, well, maybe when you talk about your firm and you invest according to ESG criteria, so environmental, social, and corporate governance, we can say that these are would it be fair to say that these are non-financial factors that have an impact on the financial performance of the firm?
We think that they're financial factors.
Okay.
And in fact, we don't have we typically don't have a separate sustainability conversation. We have a question of, well, what are the long-term drivers of this particular business? And for example, culture or governance, those have financial impact. So maybe to your very thoughtful question is probably to say that we think that that qualitative factors have actually quantitative outputs.
Yeah. And maybe a question to turn to you, to the Swiss, to the foundation's reality. We know that the turnover in their portfolio is quite high. The holding period, on average, I believe, for an equity position is 3 or 4 months. So this is not very long term. What is, in your view, the reason for turning these portfolios so often, and why? What can be done to enhance the investment in a more long-term orientation.
Rising awareness. Finally, I mean, if you delegate your portfolio to a professional asset manager, they manage it at the usual style, and the usual style nowadays is still short-term turnovers. To be a little bit mean, probably a bank earns more if they have more turnover. So could be in the interest also of the asset manager to do something with the portfolio. But it's always about the same. It's about the board of a foundation has to be aware about his responsibility with the endowment, has to take care of it, has to take over responsibility, fulfill his fiduciary duties. And to achieve this finally means always fighting and engaging for those who want change something, change the system. Wherever you are, it's important not to give up and repeat your message like a broken record all the time. I started 10 years ago to tell my board we should turn our portfolio to sustainable approaches, and we did it finally last year as a fundamental decision. Right. It was talking against walls, and I think everybody of us who is in an organization which has arguments against this has to keep on engaging.
Yep. Hey, would you like to add something?
You know, in today's world, it's not difficult to know and to monitor the turnover of what is done by people to whom you delegate a responsibility, right. And you can really set what you want also to do and not to do.
Right.
With
there are also, sorry to interrupt, there are also ways to avoid this problem of churning. Yeah. You ask for a flat fee, which is independent from the number of transactions.
The second element, which I think sometimes is important also, is the objective you give yourself in investing. If you do invest in a company and you hope medium long term to double your money, you know, you make also more obligation in the way you invest, because you know, we are still in this industry, unfortunately, sometimes buying a company hoping to make 5% or 10%. And I think if you have a long-term view again, you set more objective and more, you know, bigger objective. I think the third element I would just mention to also to more general reflection. What Generation has done is to bring people with different background, with different expertise, starting with David. And I think what the industry and the financial industry could do and should do is also to bring people with much larger experience and or background in order to reconcile around a financial objective and sustainable objective, really to bring all these expertise together. And I think that's really what you have done greatly, and I think that's what the finance industry should do.
Okay. Time for one or two more questions.
Thanks very much. Hello. Thanks very much for the talk and the presentation. I think if we look at the global economy, consolidated, almost everybody will agree that sustainability is good. The thing is, unsustainable investors can find arbitrage because they do not have to pay for the cost. I mean, when we look at the impact of the environment, climate change, the health issues based on unsustainable investment, the carbon tax has been put in place actually to mitigate this kind of arbitrage in the fact that unsustainable investors will have to pay a little bit for the cost. The thing is, the calibration of this tax is probably not already at the good point. Do you think it is a good driver actually to reduce this arbitrage in doing unsustainable investment and then getting higher return? Or do you think there will be other metrics or tax incentives that could actually put at the same level the return of sustainable investment and sustainable?
Right. Well, that's a great question, and let me answer it in two different ways. First, the question around whether it's carbon tax or basically pricing externalities. Pricing externalities is one approach. A second approach, as it relates to carbon, is innovation. And that it's quite possible that even without a carbon tax, we will see a significant migration to solar, for example, over the next 3 to 5 years, simply because the cost down curve in solar is just so extraordinary. And then third, actually, is consumer preference. It's becoming clearer and clearer that a significant percentage of people are going to insist that we have lower pollution in terms of what their purchases are. So there's a number of different factors at work here. Now, I personally think that we need a price on carbon. If I had sort of only one wish, that would be it in terms of dealing with the transition to low carbon economy. The proper price, but a price on carbon. The other thing I'll say to you, and this actually will in some ways undo what I said in the beginning, but it is true. There will be examples of people who will take unethical approaches to make money. That's been true for millennia, as it turns out. And that will definitely be true over the course of the next 5, 10, 15 years. And people will make money on, for example, coal. People who will see, because we're going to use coal for the next 10 or 15 years. Increasingly, institutional investors will not be willing to invest in that risk, but there'll be always somebody who's going to do that. There is a fund called the Vice Fund. There are people who just don't care, as it turns out. But the question, of course, is what happens when the music stops? So I used the example of Valiant. Some of the smartest and best investors in the world were in Valiant. And they were in it because they didn't really think carefully about what the guy was doing, what they were actually doing. But as soon as it became clear what they were doing, they realized they had a major problem. And so you can choose to do things unethically or nearly unethically, and you might get away with it. But the chances are increasingly, because of technology and communication and social media, your ability to get away with it is going to be diminished. And the last point, which is a little bit inconsistent, is that in the end of the day, as an investor, as a finance person, and this is something that Mr. Lombard has talked about for a long while, you ultimately have to do the right thing in finance. I think we in finance are dangerously close to losing our license to operate. And sometimes you just have to do the right thing. And if that means you're going to earn a little bit less money, well, that's just too bad. I'd rather live with myself and do the right thing than always try to make the most money. I don't think that's a good way to run a railroad or to run a portfolio in the end of the day.
Okay. Great. I think it's time for cocktails, and you will have opportunities to obviously talk to the panelists. I'd like to thank all the panelists for being here. My key takeaway for this conference is that we should consider sustainable finance as best practice. And so maybe one day we will have conferences with just say investing and not sustainable investing. But I give you one piece of information, the last one, and I stop. March 22nd next year, save the date, we will organize at the University of Geneva here the Geneva Summit for Sustainable Finance. It's a great event. It's a one-day event, and it builds bridges between academia and practitioners on the issue of sustainable finance.